Welcome back to episode 20 of my ongoing weekly trade campaign on QQQ, currently trading at $488. I've got a short put expiring out of the money today and a covered call, also out of the money, expiring in 1 week. I'll choose a strike price for my next cash secured put and check up on the GTC order or good till canceled order for rolling the covered call, which I placed last week and unpacked in more detail in one of my Options Insights editions. Let's get going. Today is September 27th, and I have a cash secured put with a strike price of $468 that is expiring today. It's only worth about 50 cents, so rather than trying to buy to close it and roll this position, I'm just going to leave it to expire at the end of the day and sell a new one. I also have an October 4th covered call with a strike price of $490 that we will talk about in just a minute. So I'm opening up the option chain and I'm going to choose a strike price for next week's cash secured put. I'm looking over here at the probability that something would expire in the money. And I always look for something with a probability of less than 20%, sometimes even down to 10%. But I am feeling a little more optimistic about this position. And since cash secured puts are so forgiving and so manageable, I'm going to go ahead and choose the $480 strike price, which is less than my $490 call, and sell this hoping to bring in about $220 and some change. Let's check and see what price I got for it. So it filled at $227, less a small trading fee. So let's go put it on the spreadsheet. So I'm very pleased with this 24.59% annualized return, and I'll hope this stays out of the money. And now let's take a look at the covered call. So I sold this call on September 10th and set a strike price of $490, which is the price at which I was assigned to buy 100 shares back on August 2nd. And I'm hoping to sell those shares for at least as much as I paid for them, but it would be better if I could get even a little bit more money for them. So I set a good till canceled order to raise the strike from 490 to 495 on this call. Let's take a look and see what's happening with that. So if we look over here in my working orders, you'll see GTC, good till canceled. Right now, it would cost about I would receive about $126 if I rolled this call up to $495 and moved the expiration date out to October 18th. I set a limit order of $255. But if we look at the position, you see this October 4th expiration. This contract still has $349 worth of extrinsic value. And that number is going to dwindle over the next week. So I'm just going to leave the order exactly as it is and hope that between now and next Friday, I may get an execution and receive $255 and have a later strike price, a later expiration date with a higher strike price. So there's really nothing to do here. I'm just going to leave that one alone, and let's go and sum up everything on the sheet. Let's just do a status report. So I'm going to I'll leave this line there. I'm just going to take a look and see where things are. My total expense and income to date, going all the way back to when I bought 5 shares on May 16th and sold a put on May 17th. So based on 124 shares and my out-of-pocket cost of $57,125, my average investment per share is $460 and some change. Let's take a look at the net liquidating value of the entire position right now. So if I wanted to close all of this out for cash, I could probably receive $59,784. So right now, the position is up about $2,600, $2,658. I own 124 shares, and we'll just keep chipping away at it and trying to decrease our cost per share and increase our share count. I'll see you next week on October 4th when we'll adjust both of these positions.